Somebody said up ki bar 20,000. We are on our way. I don't know if we'll correct from there or no, but 19,000 is an important landmark from the perspective of the fact that the Nifty is risen from those lows of 16,800 and stayed higher quite admirably. Good time to get in a very important voice, a large voice thinking about how to think about such a milestone as well in this journey. Ashwini Agarwal of Demeter Advisors joins us right now on the show. Ashwini, great having you. Thanks for taking the time out. I know you would say that we always keep on eclipsing milestones, and this is one more. But still, from the perspective of the fact that we were looking at the Nadir sometime in Feb and March, and from there it's been a good run. What do you make of this?
Hi, Neeraj. Thank you for having me here and for your question. I think, a lot of things have changed in the last 2 or 3 months. The first, we must not forget that the global narrative has improved significantly. In March, if you recall, we were all worried about the fallout of the banking crisis or the mini crisis that was unfolding in the US. The Credit Suisse drama, which resulted in UBS bank acquisition of Credit Suisse, aided by the Swiss government, also played out during that time. So, very, very large landmark events, which made people globally very nervous about what's around the corner. Since then, we've pretty much figured out that the financial system in the US seems to be all right. The rate story is playing out in a way that suggests that the US economy is actually doing a lot better than what most people had expected, a quarter ago. And if you think about it closer home in India, the macroeconomic strengths are very visible. Your current account deficit numbers have started to look good. Your inflation data started to look better. RBI has clearly stated that it wants flat to lower rates, and I think RBI's future direction is going to be more dependent on what the US does, though it would like to cut rates going ahead. So, and the earnings season, last but not the least, has actually turned out to be a lot better than maybe what we were expecting in end March, beginning April. So a lot of things have changed and changed for the better. In the midst of all this, India has become a center of attention in the sense that you saw the coverage of Prime Minister Modi's visit to the US last week. In April, we saw Tim Cook visiting India. And subsequent to that, all the attention that came into India over the last 2 months or so. And this week, Goldman Sachs board of directors is visiting India after a gap of 11 years. So in this rapidly improving global outlook, India seems to be getting a fair amount of attention. And so this is what explains the journey from, say, 17,000 to 19,000. And where do we go from here is the obvious question, right?
Yes.
My sense is that there are still pockets of fairly attractive valuations. The banking sector still has not participated in this upside. So who knows, there might be more to come. I mean, I think this rally is a little bit long in the tooth. So from a time and duration and the increased perspective, I would expect a healthy correction. But I think just looking at how India is positioned and looking at where earnings are going and how valuations are still reasonable in pockets, I just could be wrong. There may be no correction in the short term.
Yeah, I mean, I'm just wondering, the skeptics of this corrective move would argue, Ashwini, that if you look at it from the last 18 months period, the headline numbers, circa, have largely been flattish, of a few 100 points here and there on the Nifty. So therefore, could it well happen that we might not see a very large corrective move, and pockets within, below the Nifty headline, which are getting these order flows, the railway companies, the defense companies, etc., might continue to march on?
Yes, you're absolutely right. I'm not so sure about defense and railway companies because they've done so well and the valuations there are quite stretched. But, banking sector, which I spoke about, it hasn't participated in the rally in the last 3 months.
But that's like headline Nifty, right? That has an impact on the Nifty too. I was just thinking about non-Nifty.
Correct. No, so even within Nifty, while you may see some corrections in some pockets, there are other parts of Nifty that can continue to hold up.
Sure.
That's the point I'm trying to make. So, overall in Nifty, you may not see a very big decline because the banking sector, which is the largest piece of the Nifty hasn't done anything and it might catch up. And to your point, I mean, if you dig deeper and go into, let's say, beyond the top 500 market cap companies, I mean, there are lots of businesses there which are doing reasonably well and valuations are quite all right. And I think the question I'm trying to get my head around is that we had a lost decade or so between 2011 to 2021. Okay, variety of reasons. I mean, you had the taper tantrum, then you had demonetization, then you had GST, then you had the COVID. Indian banking crisis, if you will, the ILFS, Yes Bank, Divan housing drama, and then you had COVID, right? So through this decade, there was a massive reset in terms of what small and mid-sized businesses could do. Is it possible that they are now actually out of the woods and they'll begin to grow? So there is China plus one, there is energy prices and raw material prices acting as tailwinds, and there is investment demand coming through. And if that happens, Neeraj, then we might be in a situation where your earnings surprise us for the next 2 or 3 years. So that's the upside case. If you want to look at what could go wrong to a bear call, this is what can go wrong if you are expecting correction.
Got it. Ashwini, just a couple of other questions. I would love to understand how you, as somebody who's managed a large fund and then a large family office currently, think about it. That it's always argued that Indian markets are trading at a premium. But I reckon you go at any point of time in the last 10 years, even when India has not done well, it's lined up traded at a premium. Now here we are sitting on the back of 3 continuous years of double-digit earnings growth. And if all goes well, as you are saying, we may see more, which kind of keeps Indian equity growth story in a slightly different bucket than most other large markets of this size or higher. Does that therefore then mean that people will be willing to pay a premium on the Indian multiples? And I'm talking about large global money coming into India.
Great question. Okay. If you look back over the last decade or so, okay, the areas where you saw the massive multiple re-rating in the Indian context, and dare I say even in the global context, was FMCG, fast-moving consumer goods or consumer staples names. And several of these are very well-established, reasonable growth, but nothing spectacular type of businesses, right? With significant brand value and et cetera, as the drivers of value. But if you look at earnings growth is pedestrian, say 10, 15% or somewhere in that ballpark. And you saw the valuations of these stocks go from 30x to 50x in the Indian context. So what happened? Why did that happen? Because these companies were giving you steady growth in an environment where growth wasn't there. Okay. So I spoke about the lost decade. The lost decade applied to the banks, lost decade applied to the entire manufacturing sector and so on. And within that, there was a small microcosm of companies that were growing. Think about it as India versus the rest of the world. Okay, India is one of the few countries that's growing in a world which is struggling to grow. And that to me is the real story here. And if I just put my thinking cap on and see what happened to FMCG stocks in a zero growth environment or low growth environment, at a country level, the same thing applies. So I think looking at valuations or premium to valuations is a bit of a wrong thing, number one. Number two, in the EM context, India's premium has expanded because China, for one, the markets have corrected after the first Q1 rally. And that has brought valuations down to significantly below their median levels, their long-term median levels. So, in comparison, of course, therefore India looks that much more expensive. I was reading a report this morning where an Asian strategist was saying that India trades 2.8 times above, the Asian EM median. And that's true because, the other countries have fallen, predominantly China, which is a fairly large weight market. So, when you think about it from that perspective, and then you zoom out and say, okay, does that mean that people will take money out of India and put it into China? I mean, yeah, that might happen for sure. But I think there's geopolitics at work, there is trust at work, there is growth at work, and I think a lot of those intangibles are getting built into the valuation. So looking at numbers might tell us the wrong story.
Got it. Ashwini, the final question, and I'm just thinking of it, so excuse me if it doesn't come out right, but here's my question to you. We are at 19,000, right? And in the next, let's say, I understand from all our conversations that we've had that you are a long-term investor, right? You may be fully invested currently as well. Okay. My question is, what are those buckets where you believe that even if there were to be a slightly more than a stronger correction and not just an average correction, those pockets you would not touch because you believe either by virtue of the earnings growth or a 5-year out multiple growth or a combination of both, you see some strong gains out there possible? What are those really long-term bets that you're making while the Nifty is at 19,000 and you're preparing for whatever number hazard might be there on the Nifty a few years out?
So, I really don't know how to answer that, except that I'll go back to what I've shared with you in the past and how I look to invest. Okay. So there are principally two legs to investing the way I think about it. One is where you can find great businesses at a very, very good price because they're going through a crisis. Okay. Now, sometimes that crisis is resolvable, another time that crisis is not resolvable. And I think our job as investors and as analysts and so on is to figure out where the crisis is resolvable. And if we can find a good business going through a crisis, it's a great investment opportunity. And I keep looking for those and I continue to find them. I'll give you an example from the past. It's not valid today, but I'll give it to you from the past. 2 years ago, 1.5 years ago, we were looking at Wonderla. It's a company which has a serious moat around the business because it's virtually impossible for somebody to replicate the 3 theme parks that they have in Kochi, Bangalore, and Hyderabad. I at least wasn't in the camp that believed that everybody's going to go to the virtual world and nobody's going to visit game parks ever again. So post-COVID, when the travel restrictions ended, guess what? The business came back. The balance sheet was fine. The business is all there, and it's come back with a bang. And I'm just illustrating the kind of things that we'd like to do. And there are companies today which are going through their own crisis. And if you have a balance sheet that is reasonably strong, if you have a management team that has a long track record of delivery, and they understand what the problem is, then you can make a call that they will do something to resolve the issue. And if you can build a case for an investment like that on a 3-year basis, these tend to be very profitable. So that's leg number one. Leg number two is long-term, higher than average growth. This might be because of sector dynamics. It might be because the business is a disruptor in a large industry or a new player with a different proposition in a fairly large market, whatever have you. And sometimes, you find them, these are not very easy to find because they tend to be quite expensive to start with. But if you can figure out 1 or 2 names of, 3 names of that nature in a portfolio of 20 stocks, they can do amazing wonders in terms of returns. So, those are the kind of things that I keep looking at. And that doesn't change whether Nifty is at 19,000 or 17,000 or, whatever that number is. I hope that I continue to be able to find such opportunities. And that's what we used to do, when I was at my investment firm at Ashmore. And that's what I continue to do today for the family office.
Great. Okay, well, maybe at another point of time, we'll talk about some disruptors and how do you view them as well. But for now, it was important to get you as we hit this milestone. So thank you for taking the time out and speaking to us today.
Thank you, Neeraj.
The pleasure was ours. Viewers, thanks for tuning in.